The last few weeks were very eventful. The Fed finally dropped interest rates by 0.5%, pushing both the stock market as well as other risk assets like Bitcoin higher. We do have famous financial analysts like Tom Lee urging investors to be cautious before US elections in early November though. The ECB also cut the overnight deposit rate by a further 0.25% 2 weeks ago, and according to the Financial Times, we may in fact see another decrease in rates as soon as the middle of this month due to low growth in the EU. Not only that, a significant economic stimulus in China sent the country's stocks on a massive rally last week, with the two major local indexes, the Shanghai Composite and the Hang Seng, shooting up as much as 18 to 26% within a short amount of time. Today we'll discuss what all of this means for us as passive global ETF investors, how our portfolio performed, and if we're changing our strategy in any way. Let's begin by taking a look at how the stock market performed last month, looking at the global ETF covering the FTSE All-World Index. The start of the month was quite rough, with the FTSE All-World dropping as much as 3.8% at one point, but ultimately managing to finish September in positive territory at plus 1.48%, which means its year-to-date performance is currently sitting at an impressive 17.33%. Now let's see where the ETF portfolio I share with my wife stands in actual numbers. We're currently up 1.85% or 6,800 euros over the last 30 days and 15.5% or 50,700 euros since the start of 2024. Our Invesco FTSE All-World ETF shares, which we started buying in July instead of Vanguard due to the lower fees, are also finally up 3.3% after a couple of rough months. If you're interested in the reasons why we started buying this one, while at the same time keeping our existing Vanguard shares, make sure you check out this video afterwards. And lastly, our total return since we started buying ETFs in 2017 now stands at plus 106,400 euros with an average return of 11.25% per year since then. By the way, you can find the best low-cost brokers for ETFs in Europe linked down below in the description, which is a great way to support me if you'd like to. One reason why the stock market turned around may be due to the Federal Reserve in the US finally cutting interest rates for the first time in over 4.5 years since March 2020, with more cuts expected to come later this year. Since a less stringent monetary policy tends to be a positive signal for stocks, at least when nothing else is broken in the economy, the stock market has been rallying since. Historically speaking, stocks in the US have been up an average of 9% in the 12 months following a rate cut, when the S&P 500 was within 5% of its all-time high, as was the case during the latest cut. And over a 3-year period following a first rate cut, once again with the S&P 500 within 5% of its all-time high, things are looking even better historically with an average total return of 51% after 3 years. There are obviously no guarantees since it's impossible to successfully predict how the market is going to move in the short term, but as you can see, at least based on historical data, there's no reason to be worried. Having said that, Tom Lee, a famous financial analyst who has been right more often than not over the past couple of years, is urging investors to be cautious before US elections on November 5th. Here's what he had to say.
I think the Fed unleashed us on an easing cycle, and that's going to be positive. We know it's actually historically positive 3 months, 6 months out. But what stocks do in the next month is a bit of a coin flip, and I think that's what we're seeing because there's some repositioning that took place. And also we're now thinking about the 40 days into the election.
So does the fact that the election is but 40 days away sort of ruin the perfect scenario for stocks to get that post-Fed bump?
I think it delays it, just because, in the conferences that I've been speaking at and seeing wealth managers and family offices, a lot don't want to commit capital until after Election Day. And I don't think it matters who wins. It's just they want to get that event behind them.
Oh, so you think we're going to have sort of a dash to the finish after Election Day is out of the way?
Yeah, and that's pretty typical. In fact, in election years, the November, December rallies are pretty tremendous. And in fact, when markets are up more than 10% in the first half, you also get big rallies November, December, sort of choppy through September.
So basically, whether markets move up or down until the election is a bit of a coin flip, but if history is any indication, we're likely to see a rally afterwards no matter which candidate wins. Does this mean you should stop investing or change your investment strategy until November 5th? Of course not. It simply means you shouldn't be surprised to see more volatility than usual this month. Speaking of markets moving quickly, A massive economic stimulus in China sent the country's stocks flying higher, with its two major indexes, the Shanghai Composite and the Hang Seng, shooting up as much as 18 to 26% within a single month. If you're investing in emerging markets either via an emerging markets ETF or via a global ETF like the FTSE World as we like to, then your portfolio is also currently profiting from Chinese stocks performing well this year. In fact, we're finally seeing something we haven't seen in quite a while. Emerging markets have been outperforming stocks from developed markets in 2024 so far. And I wouldn't be surprised to see them continue to outperform for a while, as they have some catching up to do when looking at the past few years compared to stocks from developed markets. Either way, I'm happy that a simple ETF investment strategy where my wife and I just buy a single ETF, the Invesco FTSE World on a monthly basis, covers the entire world, including stocks from emerging markets like China, according to their market cap, as I never want to ask myself a few years or decades down the line if we made the right decision by excluding a specific region. I'd rather own all of the most productive companies from the entire world, no matter in which country they're based in, now and in the future. As I mentioned in the intro, the ECB cut interest rates again about 2 weeks ago, which means the short-term deposit rate now stands at 3.5% per year. Since Trade Republic is still passing it on 1-to-1 without taking a cut, in September we earned a total of 95 euros in interest on our cash reserves there, secured by 100,000 euro bank deposit guarantee. Plus, once again, an extra 15 euros from the 1% Saveback using the Trade Republic card for all of our expenses as a family. According to the Financial Times, we may sadly see another decrease in rates as soon as the middle of October due to low growth in the EU, and likely also because inflation seems to now be under control. While it's disappointing to see rates continue to drop from a high of 4% just 4 months ago, I think this shouldn't come as a surprise. After all, very few of us, me included, ever expected them to go that high to begin with. Now let's quickly take a look at my highly speculative small allocation to Bitcoin, which I somehow always get negative comments about whenever I mention it. I get it, some people hate it with a passion and that's okay. But I want to be open and transparent about what I choose to hold in my personal investment portfolio, so here we are. Bitcoin had a great month, finishing up around 7.8% and sitting at a year-to-date return of 49.7% so far in 2024. Based on its historical returns, October and November tend to be some of the best performing months for Bitcoin, so I do have high expectations. But let's see what happens. As for our overall investment strategy, my wife and I are not planning to change anything, no matter what happens before US elections or who ends up winning. We'll keep buying a single ETF covering the FTSE World at the start of every single month via automated recurring investments and whenever I have some extra cash to invest, since I'm self-employed and don't make my money on a fixed date each month. And while the vast majority of our monthly savings are going into that one ETF, we're planning to keep investing around 10% in Bitcoin as a speculative high-risk bet using VWCE. Allocating to this risky asset has worked very well for us since 2017 in addition to ETFs, but it's of course not for everyone. Then by the end of the year we'll see where things stand and if we need to do some rebalancing so that we're not taking on more risk with our overall portfolio than we're comfortable with long term. Alright, before you take off, don't forget to gently tap the like button if you enjoyed the video and to subscribe if you haven't yet. If you'd like to support me, feel free to use my links in the description below to the best local brokers in Europe for ETFs and other financial tools I use. None of what I talked about today was of course meant as investment advice. I'm just sharing my personal opinion based on my own experience as an investor. Thank you guys so much for watching, have a wonderful day and until next time.